If you are an African in the diaspora, this message is for you. You've thought about investing back home, maybe not seriously, but the idea keeps returning. Every headline tells you Africa is risky. Very few explain where opportunity is quietly forming. This video is not about fear, it is about preparation. Because right now, there is a tax you are paying. You don't see it on your bank statement, and the taxman didn't send you a bill, but it is costing you more than any failed project ever could. It is the cost of your hesitation. Most of us believe that safety means keeping our money in Western savings accounts, real estate, or index funds. We believe that keeping capital away from Africa is the prudent, responsible choice. But here is what is actually happening. While you are paying a premium for safety in saturated markets, a quiet shift has taken place. The gap between perceived risk and actual risk on the continent has created a wealth window. The mistake you are making is waiting for Africa to look like Switzerland before you invest. By the time that happens, the opportunity will be gone. In the next 20 minutes, I am not going to convince you to throw money at a project. I am going to teach you a framework for asymmetric risk. You will learn how to measure the difference between danger and uncertainty and how to position yourself on the right side of that equation. I know why you haven't moved yet. It's the stories. We all have them. The uncle who sent shipping containers that never arrived. The cousin who was supposed to build a house in the village but only built the foundation before the money ran out. The land dispute that has been in court for 15 years. These aren't just stories to you. They are emotional scars. They are warnings whispered at family gatherings from London to Atlanta. You feel a deep protective instinct over the money you have worked so hard to earn in the diaspora. You tolerate long hours, cold winters, and systemic barriers to build that savings. The thought of losing it to a scam or incompetence feels like a betrayal of your own sacrifice. So you freeze. You tell yourself, I will do it when the government changes, or I will do it when there is less corruption. But underneath that logic, there is fear. Fear of being the fool. Fear of being the one who should have known better. And while you wait, you watch. You see others claiming to make money, and you wonder if they are lucky or lying. You feel stuck between the desire to build a legacy back home and the terror of losing your future. But I want you to consider something. What if the thing you are most afraid of, the chaotic, messy, opaque nature of the market, is actually the only reason the opportunity exists? Let's look at the reality of 2025. Not the headlines, but the numbers. For the last 3 years, while Western markets have wrestled with sticky inflation and high interest rates, specific African sectors have quietly decoupled from the doom narrative. As of late 2025, look at the bond markets. While you might be getting 4 to 5% in a high-yield savings account in the US or UK, 10-year government bonds in places like South Africa have hovered around 9 to 10%. In West Africa, the BRVM Composite Index has seen sectors outperform the S&P 500 significantly over the last 18 months. Why? Because capital is scarce. When capital is scarce, it demands a higher return. But the environment has changed. 10 years ago, you had to trust a person. Today, you can trust a structure. We have seen the maturity of regulated fintech platforms, companies like Lemfi and others that have moved beyond simple remittances into actual wealth management. We are seeing the rise of blended finance in infrastructure projects in Kenya and Côte d'Ivoire, where development banks take the first loss, protecting private investors like you. The economies are diverging. We used to say Africa is rising. That was lazy. Now we see that while some giants like Nigeria are navigating complex currency adjustments, smaller, agile economies like Rwanda and Senegal are projecting growth rates above 7% for 2026. The risk is not Africa. The risk is a lack of nuance. The market has matured. The question is, has your thinking matured with it? Information, however, is not enough. You can have all the data, but if you don't know how to read the story it's telling, you will still stay on the sidelines. Let me tell you about two investors. Let's call them David and Sarah. It is 2020. Both are professionals living in Chicago. Both have managed to save $50,000 intended for investment back in Ghana. David is careful. He hears the horror stories. He decides that the risk is too high. He wants guarantees. So he keeps his $50,000 in a safe US index fund. He tells himself he is being prudent. He is waiting for the corruption to end. He is waiting for the currency to stabilize perfectly. Sarah is also careful, but she is curious. She realizes that she cannot trust her cousin to run a business, but she can trust a verified sectoral trend. She looks at ag processing, turning raw cashews into packaged products for export. She doesn't try to start a farm herself. Instead, she invests that capital into a managed, regulated fund that focuses on export-focused agribusinesses. 5 years pass. It is now 2025. David checks his account. His portfolio has grown, maybe to $70,000. He feels safe. But when he visits Ghana, he realizes his purchasing power there has barely moved because property prices in the prime areas he wanted to buy have doubled. He waited for safety, but he was priced out by growth. Sarah's investment had a rocky start. There were supply chain issues in 2022. She panicked for a moment, but because she was in a structure, not a solo project, the fund pivoted. By 2025, the export demand exploded. Her initial stake didn't just grow in value, it paid dividends in foreign currency. But here's the turning point. David looks at Sarah's success and says she got lucky. He refuses to see the decision-making process. David's $50,000 is still money. Sarah's $50,000 has become a position. She now owns a stake in the infrastructure of the country. David paid the tax of fear. He preserved his cash, but he lost his entry point. Sarah accepted uncertainty, managed it, and bought her future at a discount. So how do you move from David to Sarah? You need a framework. I call this the investment hierarchy of trust. Before you spend $1, you must answer 3 questions in this specific order. Level 1, the macro filter. Don't ask, is Africa safe? Ask, does this specific country have a mechanism for me to get my money out? Look at repatriation laws. Look at currency liquidity. If you cannot exit, you have not invested, you have donated. Level 2, the structural filter. Never invest in a person, invest in a structure. Does this opportunity have a board of directors? Is it audited? Is there a regulatory body I can complain to? If the answer is, my uncle is a good man, you stop. If the answer is, this fund is regulated by the Capital Markets Authority, you proceed. Level 3, the sectoral filter. Are you investing in luxury or necessity? In a volatile market, luxury is the first to die. Necessity, food, logistics, energy, affordable housing is immortal. The diaspora often invests in luxury, building big holiday homes. The wealthy locals invest in necessity, processing food, transport. Be like the locals. If an opportunity passes the macro, the structural, and the sectoral filter, only then do you look at the potential return. I want to pause here for a second. I can feel some of you tensing up. Maybe you are thinking, this sounds good, but you don't know my family, or I've been burned before even with structures. That hesitation is healthy. It means you are taking this seriously. I want you to go to the comments right now and write down the one specific thing that stops you. Is it the currency devaluation? Is it the lack of trustworthy partners? Don't just think it, write it down. When you name the fear, it stops being a ghost and starts being a problem we can solve. Now, let's get practical. Based on the year 2025, here is your playbook. What not to do. Do not start a business remotely. If you are not on the ground to unlock the doors in the morning, you do not own a business, you own a charity for your employees. Do not be the first money. As a diaspora investor, you should not be an angel investor unless you have millions to lose. Do not fund ideas, fund revenue. Let the locals take the risk of starting. You bring the capital to scale what is already working. What to do? 1. The test first model. Take 1% of your investable income, just 1%. Put it into a diaspora bond or a fractional real estate platform, not to get rich, but to test the pipes. See how the reporting comes in. See how the dividends land in your account. You are buying data. You are buying comfort. 2. Hunt for hard currency revenue. Look for businesses that live in Africa but earn in dollars, euros, and pounds. Exporters, tourism, tech outsourcing. These businesses are naturally hedged against local currency inflation. They are the golden goose of diaspora investment. 3. Leverage the perception premium. Look for assets that are undervalued simply because they are in a bad neighborhood. A factory in a stable region of a country with a bad reputation is often priced at a massive discount. Your job is to know the difference between the reputation and the reality. This brings us to the most important insight of this video. The one thing that separates the wealthy diaspora from the fearful diaspora. You view the risk of Africa as a barrier. The wealthy investor views the risk of Africa as a moat. Think about it. If investing in Nigeria, Kenya, or Ghana was easy, if the legal systems were perfect, if the data was crystal clear, then BlackRock, Vanguard, and the massive sovereign wealth funds would have already bought everything. They would have driven the prices up so high that you couldn't afford to enter. The only reason you, an individual with limited capital, have a shot at double-digit returns is because it is scary. The fear of the Western world is keeping the prices down for you. The lack of infrastructure is the opportunity. The difficulty is the only thing protecting you from being priced out by Wall Street. Your fear isn't protecting you. Your fear is blinding you to the fact that you have a home field advantage. You know the culture, you know the language, you have the resilience. Wall Street doesn't have that. The perception premium is real. The world perceives high risk, so they stay away. You know the nuance, so you can enter. That gap is where generational wealth is created. I want you to imagine yourself 10 years from now, 2035. The continent has continued to grow. The gaps you see today in energy, in housing, in food have been filled by someone. The businesses that solve those problems are now giants. Will you be the person who visits home and complains that everything is so expensive now? Or will you be the person who looks at those businesses and says, I own a part of that? The difference isn't money. The difference is courage. Not the courage to be reckless, but the courage to study the game, ignore the headlines, and trust your own heritage enough to bet on it. Don't let fear keep you poor. Let strategy make you wealthy. If you are ready to start thinking like an owner and not just a sender, make sure you are subscribed. We are going to go deeper into these frameworks in the next few weeks. And if you want to understand the specific sectors I mentioned today, I have a recommendation for you to watch next. Watch the 3 Sectors Recession-Proofing Africa right now. It's the practical next step to what we just discussed. I'll see you there.